Another very important factor that unfortunately many businesses either don't understand well or ignore is the timing of the repayments. Timing of the repayments means that when you take a loan, let's say you take a loan of $100,000, you're taking it for a year. And there's this thing that is done, it's called an amortization schedule. When you take a loan, you don't just pay the interest. Remember, you're taking a $100,000 loan at 10% interest, 10% per month, right? What it means is that every month you have to pay 10% on the loan. But that's not how loans are repaid, because there are two components to the loan. There's the principal, which is the main loan you took, the $100,000, that's the principal. There's the interest, which is the cost of using the loan, which is the $10,000, 10% of $100,000, right? When you're paying back a loan, you're expected to pay back the interest that you've used for that period plus a part of the principal. So when you're paying back the loan, the interest per month is $10,000, but to pay back the loan, you pay back $10,000 plus a part of the $100,000. Sometimes, if we if we divide it, the $100,000 divided maybe about $8,000 to $9,000. So every month you have to pay $8,000 or $9,000, which is a part of the original $100,000. So you pay $9,000, which is a part of the $100,000, plus the $10,000 interest. So what it means is that every month you must pay cash of $19,000. Now, why this is important is that the cash demand is different from the interest demand, right? The interest is the cost of using the loan. The loan component, the amortized part of the principal is the part of the original loan that you took. So even though you think the loan is costing you 10%, $10,000, which is 10% of $100,000 every month, you are correct. But in terms of cash, you will pay back $19,000 because you're not just paying back interest. You're paying back interest plus a component of the principal. So you're not just looking at, can my business afford the cost of the interest, which is $10,000? You're also asking yourself, can I generate up to $19,000 every month to pay back this loan? So that is a critical part. Sometimes your business can afford the interest, but the problem is your business may not have the cash to pay back the amortized components at the end of the month, which is a cash problem. So what this does is that if you can influence the timing of the repayments, so here's what I mean. I've taken a loan of $100,000. We've agreed interest of 10% per month, right? So every month I'm supposed to pay you $10,000, which is 10% of 100,000, plus a component of the principal, 9,000, so 19,000. But the way my business is going, I want to use that money to buy equipment. When I buy the equipment, it will take me time to install the equipment, train people to use the equipment. It will take time to bring up the equipment to speed until we hit peak production. From estimates, I think it might take up to 6 months before we start seeing the impact of the new equipment on my business. It will take 6 months, but the bank wants you to start paying in 30 days after you take the loan. There's nowhere you're going to get that $19,000 from, because the thing you spent the loan on is not yet generating enough funds. So what you can do is you can influence the timing of the repayments and say, looking at the cash profile of my business, we've looked at when this equipment will become functional and start yielding profits. By the 7th month, we're going to be in a lot of cash. So what you're going to say is, you're going to give me this loan now, this $100,000. I won't pay you anything for the first 6 months. But by the 7th month, I will start paying. That 6 months of, which can be called the grace period, or technically known as a moratorium, right, buys you time. It doesn't put you under stress, because where are you going to get the fund? Where are you going to get the cash from? You can't get it because of what you're using the money for. So you see what I mean by two businesses can take the same amount of capital for the same type of business. That money they take ends up crumbling one business but helping the other business, because your context is going to be different. You want to use your money to buy equipment. I want to use mine to hire more salespeople. The impact on cash will be totally different. So you need to take that into consideration when you are taking a loan, because if it's not the interest rate or the duration of the loan, the tenor of the loan, it might be the timing of the repayments.